Wow, this is absolutely crazy. Welcome everyone to our latest explainer. We are diving headfirst into UnitedHealth Group today, and let me tell you, the situation right now is just fascinating. We are looking at an absolute titan of the healthcare industry, a massive $449 billion company, and the numbers coming out right now are staggering. The stock has been hovering right around the $380 mark after a really massive run. And then, out of nowhere, the board just approved a surprise 5% dividend hike, bringing it to $2.32 per share. But if you look beneath the surface of this behemoth, there is a fierce tug of war happening. You have their actual, unbelievable financial scale pulling one way, and some incredibly heavy regulatory shadows pulling the other.
That is exactly the situation we are seeing, but the headlines you are reading every day, they only tell a fraction of the real story. Today, let me break this down for you. We're going to unpack the three real causes perfectly hidden behind those flashy news headlines. We aren't just looking at a simple dividend hike. If you look at the data here, we have to analyze the underlying operational data, the massive structural shifts in their business model, and the very specific triggers that will strictly dictate this company's valuation going forward.
To do this logically, we will follow a strict roadmap today. First, we will look at headlines versus reality. Second, we will conduct a financial deep dive. Third, we'll examine the Optum economic moat. And finally, we will lay out three concrete survival scenarios.
Okay, so let's start with the reality of what's happening right now. We've all seen this stock cool off recently after a truly massive 28.9% three-month rally. But why is the momentum suddenly stalling out? Are the news headlines just completely spooking retail investors?
The short-term momentum has indeed cooled. It is proven by the numbers. We saw a drop of about 2.1% in a single week in late May of 2026. But to truly understand why the stock accounts of retail investors are fluctuating so much, we have to completely ignore the daily noise. We need to look directly at the company's dual-engine structure. The market is currently weighing three hidden factors: drastically shifting medical costs, unprecedented federal regulatory scrutiny, and a massive foundational transition in how they actually deliver healthcare.
Okay, hold on. For those of us who just see the words insurance company when we read the name UnitedHealth Group, how does this $449.7 billion machine actually work in plain English? Because that scale is almost too big to comprehend.
Let me break this down for you using a very simple analogy. Think of UnitedHealthcare as a massive, privately owned national highway system. Now, UnitedHealthcare, which is the traditional insurance arm, is the toll booth. They systematically collect premiums from over 49 million people just to grant them access to this highway system. Optum, on the other hand, represents the service stations located all along that highway. Optum is the actual doctors, the data analytics systems, and the pharmacy benefit managers. So even if the toll booth happens to see less traffic on any given day, those service stations are actively charging money every single time a patient stops for clinical care, data processing, or prescription drugs. That dual-engine structure is exactly how they systematically generate $449.7 billion annually.
So what you just said basically means they have built a system where they charge you just to get on the highway, and then they charge you again every single time you stop for gas. That is an incredible, almost bulletproof business model. Moving on to stage 2, our financial and fundamental deep dive into the first quarter of 2026. So, if they are making such incredibly good money on both ends of that highway system you just described, why is the stock price seeing all this hesitation?
To answer that logically, we go straight to the first quarter 2026 results. If you look at the data here, consolidated revenues hit exactly $111.7 billion. That is a 2% growth year over year, compared to the $109.6 billion they reported in the first quarter of 2025. Furthermore, their earnings from operations remained remarkably stable at $9.0 billion. And they successfully generated $8.9 billion in cash flows from operations in just a 3-month window. It's proven by the numbers that they are generating immense cash reserves, which they are immediately utilizing to buy back $2 billion of their own common stock.
Wait, $111 billion in a single quarter? That is literally larger than the GDP of many developed countries. That's unbelievable. It is an immense scale, exactly. But here's the nuance we have to examine. The most absolutely critical number for any health insurer is the medical care ratio, or MCR. By definition, this is the exact percentage of premium revenues the company actually spends on clinical services and quality improvement. In the first quarter of 2026, their MCR successfully improved to 83.9%, which is down from 84.8% a year ago. This structural improvement came directly from their internal affordability initiatives and highly favorable reserve development. This effectively offset the expected elevated medical costs in the industry.
Okay, wait a minute. Let me make sure I'm getting this right. So a lower MCR means they are actually spending less of the incoming premium money on paying out medical claims, which means they are keeping more of those premium dollars as pure profit.
But wait a minute, doctor. What does that have to do with our stock accounts? If their profit margins on the insurance side are actively improving and their total revenues are up to GDP levels, why did I read a headline saying they just lost 965,000 Medicare Advantage seniors in the first quarter of 2026 alone? Losing nearly 1 million customers sounds like a total disaster. Are people just abandoning the toll booth altogether?
That seemingly contradictory data point is the exact cause of the market's current hesitation. UnitedHealthcare actually served 1.1 million fewer people overall this quarter. But if you look at the underlying data, this was primarily due to intentional benefit design, aggressive pricing actions, and reduced Medicaid eligibility across various states. They actively and deliberately chose to shed unprofitable contracts. They lost those seniors because they purposefully repriced their offerings to aggressively protect their profit margins against newly tightened federal funding rules. It was a cold, calculated sacrifice of sheer volume in exchange for strict profitability. They essentially closed down the unprofitable lanes of the highway.
And this is precisely where the dual-engine business model saves them from a massive revenue collapse. While the UnitedHealthcare insurance arm brought in $86.3 billion, the Optum arm concurrently generated $63.7 billion, actively serving over 122 million consumers. Optum is continuing to reliably deliver steady mid-single-digit growth. So while the traditional insurance side is intentionally shrinking its geographic footprint to meticulously maintain profit margins, the Optum services engine is constantly expanding, entirely absorbing the financial shock. Wow. So what you just said basically means they are perfectly fine losing nearly 1 million toll booth customers because the Optum service stations are picking up all the financial slack. They are keeping the whole highway incredibly profitable even while they intentionally reduce the overall traffic. That is wild. This brings us to stage 3, analyzing the Optum economic moat and the broader industry environment. Okay, so looking at this dual-engine setup, is this giant truly invincible, or are there actual cracks in the foundation that retail investors are missing?
To logically assess their invincibility, you have to measure their economic moat. UnitedHealth Group now operates an intensely vertically integrated empire consisting of over 2,694 subsidiaries. If you look at their acquisition history, it is staggering. They acquired DaVita Medical Group for $3.4 billion back in 2019. Then, in 2023, they bought Change Healthcare for $8 billion and LHC Group for $5.4 billion. And now, in 2026, they're acquiring Allegis Technologies to completely dominate consumer-directed healthcare accounts. They do not just casually participate in the health system, they literally own the underlying infrastructure of the system itself.
2,694 subsidiaries? Oh my goodness! They aren't just an insurance company, they are buying up absolutely everything from local doctors' offices to back-end payment processing networks. Precisely, and they are aggressively aligning these massive acquired assets directly with undeniable market megatrends. According strictly to the America's Health Rankings 2026 Senior Report, the total number of home healthcare workers increased by 5% just between 2023 and 2024. Furthermore, reported physical inactivity among seniors decreased by a significant 16%. UnitedHealth is actively capitalizing on this aging, yet more active, demographic by vastly expanding in-home clinical care through their house calls program. Simultaneously, their first quarter 2026 operating cost ratio actually increased to 13.8%. Why? Because they are pouring billions of dollars into artificial intelligence and cyber investments. The AI basic role here is fundamentally reshaping their entire infrastructure. Its core objective is to forcefully modernize this massive network of nearly 2,700 subsidiaries. The AI is specifically tasked with automating complex prior authorizations, streamlining convoluted medical billing, and ultimately driving down that 13.8% operating cost ratio over the long term.
That is incredibly fascinating. So they are actively spending tons of cash right now, actually intentionally raising their own operating costs to 13.8%, just so they can deploy this AI. The core objective is to completely dominate the tech space in healthcare later and eventually run all those thousands of subsidiaries on autopilot.
Exactly. However, as an analyst, we must logically and coldly assess their fatal risks because they are severe. First, they are facing highly active Department of Justice antitrust probes and incredibly heavy federal scrutiny over their historical Medicare billing practices. Furthermore, they are still actively managing the severe financial and operational fallout from a massive 2024 cyber attack where hostile hackers successfully used stolen credentials to deeply breach their core systems. Most tragically and unexpectedly, the company underwent a sudden, highly violent leadership shock when CEO Brian Thompson was fatally shot outside a Manhattan hotel in December 2024. This tragic event directly led to Tim Noel taking over as the new CEO in early 2025, forcing a major leadership transition during a time of crisis. Good grief. That is an intense, almost unimaginable convergence of headwinds. You have a $449 billion giant trying to navigate massive federal antitrust probes, catastrophic cyber vulnerabilities, and a literal physical tragedy at the very top of their corporate ladder. This leads us directly to stage 4, the 3 survival scenarios and our future forecast. Okay, so cut through the noise for us. Break down exactly what all this data actually means for the stock's future. What are the specific scenarios we need to be watching for our portfolios?
Based strictly on the current market models, we can project 3 distinct scenarios. The first is the bull case. Current market models suggest the stock is actually 21.9% undervalued right now, pointing to a fair intrinsic value of $486.86. The specific preconditions or triggers for this highly optimistic scenario are clear. Their massive capital investments in artificial intelligence and system modernization must successfully execute their core objective. That core objective is lowering that 13.8% operating cost ratio. If the AI's basic role successfully streamlines prior authorizations and eliminates redundant billing across all 2,694 subsidiaries, the market will aggressively reprice this stock to accurately reflect that massive margin expansion.
Okay, I see. So if the massive AI gamble actually pays off and makes running this gigantic highway system significantly cheaper, the stock shoots up to that $486 mark. But what is the downside? What happens if things go wrong? The bear case represents the absolute worst-case scenario where those fatal risks we discussed fully materialize. It's proven by the numbers that the federal government has already implemented strict new Medicare rules specifically aimed at taking back $4.7 billion from these insurers. If the ongoing Department of Justice antitrust investigations result in heavy financial penalties, or worse, if the government legally forces UnitedHealth to divest major profitable parts of the Optum engine, their profit margins will violently contract. The specific trigger here to watch is continued, forced attrition in Medicare Advantage enrollment, coupled directly with massive federal antitrust fines. This combination would fundamentally break their historical, reliable growth narrative.
Ouch. So basically, if the federal government steps in and decides a toll booth and the gas stations are an illegal monopoly and forces them to break it up, the stock takes a really heavy hit.
Finally, we must look at the base case, which is statistically the most likely future based on the current first quarter 2026 data. In this specific scenario, UnitedHealth Group steadily and methodically navigates the regulatory headwinds while continuing to financially reward its shareholders. The primary trigger proving this case is their recent 5% dividend hike to $2.32 per share. This mathematically demonstrates immense board confidence in their cash flow. They will most likely maintain steady, mid-single-digit revenue growth driven entirely by the Optum side, while the United Healthcare insurance side continues to selectively trim those unprofitable insurance members, thereby maintaining a medical care ratio right around that highly profitable 83.9% mark.
Okay, so the base case is just this steady, massive corporate machine continuing to do exactly what it does best, pumping out very reliable dividends to shareholders, while the Optum service stations just quietly keep growing and growing in the background.
Exactly. Ultimately, the logical grounds for making an investment decision here come down to meticulously watching these specific triggers. You must watch the operating cost ratio to confirm the bull case. You must closely monitor the DOJ legal announcements for the bear case. And you must track the Optum revenue growth and dividend safety to confirm the base case. When compared to major industry peers like Elevance Health or Cigna Group, UnitedHealth's vastly larger service mix via Optum makes it uniquely resilient to shocks. However, those strict regulatory triggers are the exact preconditions that will unequivocally dictate the broader market's reaction over the next 12 to 18 months.
And honestly, this brilliantly illustrates exactly why you can never just casually read a headline about a stock cooling off and make a decision. You have to look at the massive underlying machinery and understand exactly how the gears are turning.
To perfectly summarize all of this deep data for our viewers, it really brings to mind the famous quote from the legendary investor Benjamin Graham. He said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." Right now, it feels like the market is just frantically voting on all the daily noise, the DOJ probes, the million lost seniors, the cyber attacks, the tragic headlines. But in the long run, the market is absolutely going to have to weigh that massive $449 billion in total revenue, the incredible operating cash flow, and the sheer dominance of those 2,700 integrated subsidiaries. So, we want to leave you with this final, very provocative question to think about. Will UnitedHealth Group's massive Optum engine actually be powerful enough to outrun its incredibly dark regulatory shadows? We've given you all the hard data, we've outlined the exact scenarios, but now it is totally up to you to keep a close eye on those triggers. Thank you so much for watching today's Explainer. We really appreciate it. Your subscriptions, your likes, and your supportive comments are a huge, huge encouragement for our video production team. So let us know down in the comments below, are you looking at the bull case, the bear case, or the base case playing out? See you all next time.